Silver has always been called the quiet metal, too volatile for central banks, too slow for traders, too boring for headlines. And then, it wasn't. In a market already stretched thin, silver began climbing with a kind of urgency that doesn't usually belong to commodities. Not a slow grind, not a seasonal bump, but sharp, relentless buying across futures, physical demand, and ETFs. This wasn't retail hype. This wasn't social media speculation. This was pressure. And when pressure builds silently for years, the release is never gentle. What most people miss is this: markets don't explode when things are good. They explode when systems are fragile. Bond yields were already unstable. Currencies were already under stress. Liquidity was already thinning. Silver didn't create the chaos. It reacted to it. And historically, silver has always been one of the first assets to signal that something deeper is breaking beneath the surface. The real story isn't how high can silver go. The real story is why capital is suddenly running toward it. Because when investors stop trusting promises, they start demanding something real. And silver is one of the last assets that still sits between the financial system and physical reality. That's why this move matters, not because it's exciting, but because it's revealing. The idea of $200 silver sounds extreme until you zoom out. In 1980, silver briefly touched $50. Adjusted for inflation today, that level sits well above $180, and that spike didn't happen during a healthy economy. It happened during currency instability, inflation fears, and collapsing confidence in financial leadership. Fast forward to now. Global debt levels are exponentially higher. Bond markets are more leveraged. Industrial demand for silver, in solar and DVs and advanced electronics, is structurally stronger than ever. At the same time, silver mining supply has barely grown. New large-scale discoveries are rare. Production costs are rising. This creates a dangerous imbalance, not a prediction, a condition. When demand becomes inelastic and supply can't respond quickly, price stops being controlled by fundamentals and starts being controlled by stress. That's why respected macro investors are even willing to say $200 out loud. Not because it's guaranteed, yes, but because under the wrong conditions, it becomes mathematically possible. And here's the uncomfortable truth. If silver ever approaches that level, it won't feel like a victory. It will feel like confirmation that trust in traditional financial systems has eroded far more than most people realized. Silver at $200 wouldn't mean silver won. It would mean something else lost. When silver rises slowly, the system can absorb it. When silver rises violently, fault lines appear. The first stress doesn't show up in price. It shows up in paper markets. Silver is traded in two worlds at once. One is physical, bars, coins, industrial supply. The other is paper, futures, options, unallocated contracts. And here's the uncomfortable math most people never hear. For every ounce of physical silver that exists, there are dozens of paper claims written against it. That system works only as long as most participants never ask for delivery. But when price rises fast, behavior changes. Industrial users panic about future supply. Funds hedge aggressively. Some investors stop rolling contracts and start demanding metal. That's when stress becomes visible. Premiums disconnect from spot prices. Delivery times stretch. Liquidity thins. This is not theory. It's happened before repeatedly, during periods of monetary strain. And if silver were ever to approach $200, the real question wouldn't be, how high can it go? The question would be, can the paper market still function without cracking? Because once confidence in paper claims fades, price stops being negotiated. It starts being discovered through scarcity. That's when volatility turns violent. Most people assume silver moves because of retail investors. That's backwards. Retail reacts last. The real pressure comes from players who never make headlines. Industrial buyers who can't substitute silver easily. Funds hedging currency exposure quietly. Institutions reducing counterparty risk without announcing it. These players don't chase breakouts. They position before narratives form. And here's the critical detail. They don't care about $30 silver. They don't even care about $100 silver. They care about what silver protects them from. Currency debasement, bond instability, settlement risk. Silver is not being bought as a trade. It's being bought as insurance. And insurance demand behaves very differently from speculative demand. It doesn't sell easily. It doesn't care about pullbacks. It doesn't panic on headlines. That's why moves like this feel unnatural to traders. Traditional indicators stop working. Volatility spikes without clear triggers. The market isn't broken yet, but it's being tested. And every test increases the probability that something eventually fails under pressure. Not today. Not tomorrow. But markets don't warn you before the breaking point. They signal it quietly through assets like silver. Every powerful market move creates two groups. The first group positions early, quietly, with patience. The second group arrives when the move feels obvious. Silver is no different. When prices accelerate, headlines change tone. Caution turns into confidence. Confidence turns into certainty. That's when danger enters. Late buyers don't buy silver because of supply dynamics or macro stress. They buy because price confirms their fear of missing out, and markets punish that behavior relentlessly. Historically, silver does not top slowly. It spikes, hesitates, then violently reverses, often without warning. Why? Because silver is a thin market. Liquidity disappears fast when momentum flips. Stops get triggered in clusters. Forced selling feeds on itself. Even in strong secular bull markets, silver routinely falls 30 to 50% in short periods. Not because the long-term story changes, but because leverage unwinds faster than belief. This is why experienced capital treats silver with respect, not romance. They size positions carefully. They expect volatility. They assume pain is part of the trade. Anyone buying silver expecting a straight line upward has already misunderstood the asset. And misunderstanding is always expensive. Here's the line most people fail to draw. A bull market is about optimism. A systemic warning is about trust erosion. If silver were to approach extreme levels like $150 or $200, it wouldn't signal enthusiasm. It would signal distress elsewhere. Currencies losing credibility. Bond markets losing stability. Risk models failing quietly. Silver doesn't lead prosperity cycles. It responds to breakdowns in confidence. That's why silver spikes tend to coincide with moments when policymakers lose control of narratives. And here's the critical insight. If silver reaches those levels, it won't be because everyone suddenly loves silver. It will be because too many people stopped believing that financial promises will be honored in real terms. That distinction matters because it changes how this story ends. Silver bull markets don't end with celebration. They end with exhaustion, volatility, and sudden reversals. The question isn't whether silver can go higher. The question is whether the system can stabilize before silver is forced to reflect deeper fractures. Markets don't end cycles with clarity. They end them with confusion. If silver continues higher, the final phase won't look rational. It will look emotional. Price will move faster than explanations. Experts will disagree publicly. Volatility will expand in both directions. And this is where history offers a clear lesson. Major silver moves don't end because demand disappears. They end because volatility becomes untradeable. Spreads widen. Margin requirements rise. Exchanges tighten rules. Not to control price, but to control risk. These actions quietly drain momentum from leveraged participants. Speculators exit not because they want to, but because they're forced to. That's when price reversals feel sudden and violent. The headlines will still be bullish. The narrative will still sound confident, but beneath the surface, liquidity will be evaporating. This is how cycles end. Not with panic at first, but with exhaustion. And exhaustion always arrives before collapse. So let's return to the question everyone keeps asking. Could silver hit $200? The honest answer is uncomfortable. Yes. Under extreme conditions, it's possible. Not because silver is magical, but because financial systems can fail slowly, and then all at once. But here's what matters more. If silver ever reaches that level, it won't be a celebration. It will be a message. A message that confidence in paper wealth has eroded. That risk was mispriced for too long. That stability was assumed instead of earned. Silver doesn't create crises. It reflects them. And that's why it's so misunderstood. The real danger isn't missing the rally. The real danger is misunderstanding why the rally exists. Because markets don't reward belief. They reward preparation. This moment isn't about buying or selling silver. It's about recognizing stress signals before they turn into consequences. History doesn't repeat perfectly, but it rhymes with uncomfortable accuracy. And silver has always been one of the earliest rhymes. If you understand that, you're already ahead of the crowd. And in markets like these, being early matters far more than being right.